Trading in the stock market can be an exciting journey for anyone, especially for young people looking to start building wealth or gain financial independence. It's a form of investment that, if done thoughtfully, allows beginners to grow their money by owning small parts or shares of companies. But to start investing, it's crucial to know the fundamentals, the potential risks, and how to proceed step by step without overwhelming yourself. Trading is simply the act of buying and selling stocks, which represent pieces of ownership in a company. These stocks are bought with the expectation that their value will increase, leading to profits for the investor. When we hear of traders making huge profits, it can be enticing. However, trading carries its risks. The stock market can be volatile, meaning stock values fluctuate based on various factors, news, economic changes, and even social trends. So, learning to understand these changes and how they impact your investments is key. Starting to invest is easy in today's digital age, where online trading platforms have made the process accessible for beginners. Many trading platforms like Robinhood, Webull, or Zerodha offer user-friendly interfaces that guide first-time traders through the buying and selling process. To start, a person simply needs to sign up on one of these platforms, which often includes verifying their identity and linking a bank account for funding. Once you've set up an account, you can start exploring different stocks. As a beginner, it's important not to rush. Start by learning how the market works. For instance, there are two main types of market strategies: short-term trading and long-term investing. Short-term trading, often referred to as day trading, involves buying and selling stocks within a day to make quick profits. Long-term investing, on the other hand, involves holding on to stocks for years, allowing the investment to grow over time as the company expands and earns more. For beginners, long-term investing tends to be a safer, more stable choice, as it doesn't require monitoring the stock market constantly and minimizes risk compared to day trading. Next, deciding how much to invest is crucial. One rule of thumb in investing is to never invest money you can't afford to lose. Starting with a small amount is always better, even if that's just $100 or $500. This allows beginners to test their skills, make small mistakes, and learn from them without facing major financial losses. With experience, confidence will grow, and a beginner can then consider investing larger sums. Choosing which stocks to buy is another major part of the process. For beginners, investing in blue-chip stocks, well-established, financially sound companies, is often a smart choice. These companies have a long history of growth and are likely to be stable over the long run. Examples include companies like Apple, Google, or Microsoft. Many beginners also consider exchange-traded funds, or ETFs, which are bundles of stocks managed by financial experts. ETFs are less risky because they allow investors to diversify or spread out their money across various stocks, reducing the impact of any single stock performing poorly. To buy and sell stocks, it's crucial to familiarize oneself with basic trading terms and practices. The stock market operates from Monday to Friday and generally opens in the morning and closes in the late afternoon. When you buy a stock, you'll notice two prices: the bid, the price buyers are willing to pay, and the ask, the price sellers want. The difference between these prices is known as the spread, and understanding it helps beginners avoid overpaying. Beginners can use a market order to buy stocks at the current price or a limit order to set a specific price they're willing to pay. It's also essential to know why you want to invest. People invest in the stock market for various reasons: to save for retirement, earn passive income, or achieve financial freedom. Having clear goals makes the trading journey more meaningful and focused. However, it's worth noting that stock market trading involves risks, and not every trade will be profitable. Market crashes, economic downturns, and unforeseen events can affect stock prices significantly. So, patience is a virtue, and it's okay to encounter losses along the way. Investing for the long term can also come with dividends, which are payments companies make to shareholders as a reward for their investment. Dividends can be reinvested to buy more shares or taken as cash, adding a source of income to one's investment portfolio. Beginners are encouraged to choose companies that pay regular dividends, as these stocks tend to be more stable and profitable in the long run. Another important aspect of trading is the psychological element. The stock market can be emotionally intense, especially when a stock you invested in starts losing value. It's natural to feel anxious and want to sell quickly. However, good traders know how to manage their emotions and avoid impulsive decisions. This is where having a trading strategy and clear goals helps. Beginners should avoid making trades based on emotions or short-term market changes. Instead, keep in mind the bigger picture. Investments are likely to grow over time, and a day's loss doesn't determine the final outcome. Diversification, or spreading out investments across different sectors or asset classes, is another powerful strategy for managing risk. A diversified portfolio helps reduce potential losses because, while some stocks might lose value, others might gain, balancing out the overall portfolio. For instance, if you have stocks in technology, healthcare, and energy, a downturn in one industry might not affect the others, keeping your investments more stable. One of the most recommended habits for beginners is keeping up with market news and trends. Staying informed about economic changes, political events, or company updates can help beginners make well-informed trading decisions. Many trading platforms provide news updates, or you can subscribe to financial news outlets for insights. Over time, beginners might find that stock market trading opens up other investment avenues like bonds, mutual funds, or even real estate investment trusts, REITs. Exploring these options can further diversify an investment portfolio and reduce risk. For those eager to learn, many online resources and courses cover everything from stock market basics to advanced trading strategies. Free courses and tutorials on YouTube, for example, provide a solid foundation without requiring a financial commitment. Practicing with paper trading accounts, simulated trading with fake money, on platforms like Webull or TradingView is another great way for beginners to gain experience without risking real money. To sum up, while trading in the stock market holds the potential for financial growth and success, it requires dedication, learning, and smart decision-making. Starting small, choosing safe investment options, diversifying, staying informed, and keeping emotions in check are all part of what makes a successful trader. With consistent effort, the journey becomes not just about financial growth, but a fulfilling and valuable learning experience that lasts a lifetime.